Welcome to the deep dive. Right, today we're getting into something pretty substantial. It's the 2012 Shareholders Letter from Fairfax Financial Holdings Limited. Our mission for you listening is to really unpack how this major player navigated things just after the big financial crisis. The uncertainty was intense back then. We've got this great source material, and it shows this paradox, really. They were making aggressive long-term bets while also being incredibly cautious financially. Almost maximum caution. It's kind of a blueprint for surviving chaos, but still aiming for growth decades down the line.
Yeah, in 2012, it's a fascinating frame for this. Most people were starting to feel like, okay, the worst is over. But Fairfax, their outlook was still very, very cautious. They weren't looking at the market's mood. They were focused completely on long-term intrinsic value, basically ignoring what everyone else was saying.
Which takes us straight to the central puzzle in this letter, doesn't it? Their reported book value per share. It only went up 6.5% in 2012, and that includes the dividend. But management really insisted, that the company's actual value, the intrinsic value, went up way more than that. So why should you believe them over the official numbers? That's a huge gap.
It is, and the answer is those numbers were seriously skewed by their defensive moves.
Yeah.
You have to understand Fairfax's DNA. They're not about quarterly results. Look at their history since 1985. Book value per share compounded at, 23% annually?
23%. That's huge.
It's staggering.
Yeah.
And the stock price?
Yeah.
19% annually. So, they've earned the right to ask people to look beyond 1 year's numbers.
Okay. Let's dig into that defensive strategy then, because that seems to be where this billion-dollar difference comes from. Despite that amazing track record, they had this very cautious view of the financial markets in 2012. How exactly did they put that caution into action?
Well, they went pretty extreme. They were 100% hedged on their common stock portfolios.
Fully hedged. Wow.
Basically, holding derivatives that would pay off if the market fell, or rather offset losses if it did. It meant they'd give up gains if the market rose. Think of it as insurance against a collapse.
Hold on. Give up gains. And the market did rise in 2012, didn't it?
It did.
So they effectively lost out on potential returns. How much did that cost them?
About 400 basis points of return. It translated to roughly $1 billion in unrealized losses for that year.
$1 billion?
Yeah. So their total investment return was only 4.5%. Without the hedges, it would have been closer to 8.5%.
Okay, that sounds less like caution and more like an incredibly expensive insurance policy. Was that premium, that $1 billion, really worth it in their eyes?
They absolutely saw it as an insurance premium. And that's the key strategic point here for you to grasp. That $1 billion paper loss is what dragged down the reported book value. But their calculation of intrinsic value, it assumes that hedge is just temporary protection. It's a cost you pay to make sure you have cash when things get ugly. The chairman's famous line, but preferring to wait for the music to stop rather than getting stuck in an expensive dance when liquidity disappears.
Oh, yeah, referencing past crises.
Exactly. That's the core idea. Pay the premium now so you're ready later.
Okay. So the subtlety is the $1 billion loss hits the official book value, but management says ignore that for true value because it protects our ability to buy cheap later.
Yeah.
That makes the book value versus intrinsic value difference much clearer.
Precisely. They're waiting for things to get really bad for that maximum pessimism moment John Templeton talked about.
Buy at the point of maximum pessimism.
That's the one. And the hedge ensures they actually have the money to do it when everyone else is panicking or forced to sell.
Okay, but that level of caution, being able to stomach a $1 billion hit, that only works if the core business is strong, right? The engine room has to be solid. So let's talk insurance. 2012 was the year of Hurricane Sandy. Massive damage on the U.S. East Coast. $25–30 billion insured?
Yeah, huge economic damages too, over $50 billion.
And Fairfax took a hit.
They did. Their estimate was about $261 million. Most of that came from their big reinsurance arm, Odyssey.
So how did that affect the engine room?
Well, this is where you see the payoff from their discipline. Odyssey, they call it the jewel in the crown, and here's the amazing part. Despite that huge Sandy loss, Odyssey actually had its best combined ratio ever in 2012.
Okay, hang on. Remind us, what does combined ratio mean in simple terms?
Right. It's the basic measure for profitability for an insurer. It compares the claims paid out and expenses against the premiums collected. Under 100% means you made money on the underwriting itself.
And Odyssey's was?
88.5%. Phenomenal.
88.5. Even with Sandy?
Even with Sandy. It means for every $100 in premiums, they only paid out $88.50 in claims and running costs. That difference, that $11.50, is pure profit from the insurance activity itself. It generated $267 million in underwriting profit, almost perfectly offsetting the Sandy hit.
Wow. And compare that to the year before. 2011 was terrible for catastrophes, wasn't it?
Awful. Unprecedented, really. In 2011, their underwriting loss was $336 million. Combined ratio was way up at 116.7%.
So one great year basically wiped out the loss from one terrible year. It really drives home that you have to look at this business over the long haul.
That's exactly their strategy. You don't just run away from catastrophe business after one bad year, especially when losses mean rates are likely to go up. Overall, for all of Fairfax's insurance operations together, the consolidated combined ratio was 99.8% in 2012.
So just barely profitable on the underwriting side.
Just scraped by with an $11.6 million underwriting profit. But look, compared to the huge loss in 2011, it was a massive turnaround.
And fueling all this, allowing them to invest and take these hits, is the float. Can you explain that?
Ah, yes, the famous float. It's basically the money insurance companies hold temporarily. Think loss reserves set aside for future claims, premiums paid up front but not yet earned. They get to invest this money for their own profit until the claims actually need to be paid out.
And it's essentially free money, right? Or very low cost.
Effectively, yeah. It's the powerhouse behind their investment strategy. And in 2012, their float grew 5.2% to almost $12 billion.
$12 billion.
That worked out to $784 per share. It's this huge, cheap capital base that lets them, absorb a billion-dollar hedging loss but still have firepower for big long-term investments.
Which brings us back to that paradox. Extreme caution on one side, but looking at their deals in 2012, they seem really opportunistic, almost aggressive. Total contrast. How do these two personalities fit together in one company? Let's get into that growth engine.
It really is two sides of the same coin. Protect yourself short-term, position yourself long-term. A good place to start is their runoff business.
Runoff? That's taking on old insurance liabilities from other companies.
Right. It's exactly. Managed by their subsidiary Riverstone. It's a specialized skill, buying books of old, troublesome policies, often at a discount, and managing the claims efficiently.
And they did a deal in 2012.
A significant one. They bought Brit Insurance's UK runoff operation for $335 million.
Yeah.
And the key thing, they bought it for about 10% less than its stated book value. Plus, that deal immediately added $1.3 billion in invested assets to Fairfax's pot.
So they get assets cheap and add to their investment base. Smart.
Very smart. They're experts at pricing tricky, long-tail liabilities that scare others off. And they showed their efficiency, too, settling a debt note from an older acquisition 4 years early.
Okay, runoff is one thing, but they were also pushing hard into emerging markets. That Thomas Quick India deal, they bought 77%. The letter had this wild statistic about growth potential there.
It really paints a picture, doesn't it? The comparison they used was striking. Only about 1 million Indians traveled outside India for holidays annually at that time.
1 million, okay.
Compare that to 40 million outbound tourists from China.
Oh.
That difference, that gap, it just signals decades of potential growth. It's a classic Fairfax play. Deep value in a market with huge long-term upside.
And it wasn't just acquisitions, right? They mentioned their Brazilian operation.
Yeah, they started that one from scratch in 2010. And by 2012, just 2 years later, they were saying it was already on track to turn an underwriting profit. That shows organic growth, too.
So buying runoff, betting big on India, growing organically in Brazil. What else was going on? There was a sale, too, wasn't there? Cunningham Lindsey?
Yeah, yes. The turnaround story. Or maybe the finally getting it right story. Yeah. They'd owned Cunningham Lindsey, an insurance claims adjuster, for 26 years. And they were very blunt in the letter. The total return over that long period was very poor.
Ouch. Admitting failure after 26 years.
But they didn't just give up. They partnered with Stone Point, a private equity firm, and things improved dramatically. EBITDA nearly tripled to over $100 million by 2012. And then they sold it. It shows they're willing to admit a mistake, bring in help, and then capitalize on the fix.
Okay, that makes sense. But the bet that probably raised the most eyebrows, Research in Motion, BlackBerry.
Definitely the most contrarian move.
They bought about 10% of the company. At what price?
Around $17 per share, on average. And you have to remember the context. This was BlackBerry after the iPhone and Android had taken over. The stock was down something like 95% from its peak.
95%.
It was trading at maybe a third of its book value. People thought it was finished.
So why did Fairfax jump in? Were they betting on a smartphone comeback?
Not really. It wasn't about predicting phone sales. It was classic deep value. They looked past the negative headlines and saw assets the market was ignoring.
Like what? What did they see?
Well, the brand name still meant something globally. Their security system was, and arguably still is, top-notch. They had 79 million subscribers still paying fees.
79 million? That's not nothing.
Not at all. Plus, the company had almost $3 billion in cash and practically no debt.
Ah, so it was an asset play. Buying a dollar for 30 cents, essentially.
Exactly. Looking at tangible value, hiding underneath the market panic. That's their bread and butter.
Okay, so you see these aggressive moves. India, BlackBerry, runoff deals, all needing capital, all needing confidence. It just circles back to that massive hedge. What was making them so nervous about the big picture that they needed that billion-dollar insurance policy?
It boils down to macroeconomic fear, deep-seated fear. The letter spells it out. Crippling levels of debt, government debt, private debt as a percentage of GDP in the U.S., in Europe, the U.K.
Right, the sovereign debt crisis was still rumbling in Europe.
Exactly. And Fairfax felt this debt overhang severely limited government's options. It created what they called the grand disconnect.
The grand disconnect, what did they mean by that?
The disconnect was between the reality of weak economic fundamentals, slow growth, high unemployment, debt everywhere, and soaring financial markets.
Why were markets soaring if the economy was weak?
Because investors fundamentally believed the central banks would always step in. The Fed, the European Central Bank, QE1, QE2, QE3. Markets weren't pricing in real economic recovery. They were pricing in infinite support from central banks. Fairfax saw that as unsustainable, artificial.
And their worries weren't just about the West, were they? They mentioned China specifically.
Oh, yeah. Very specifically. They called out the Chinese bubble in real estate explicitly. The letter talks about vast empty cities, vacant subdivisions. They called it potentially the biggest housing bubble in history.
Wow, strong words.
They were clearly worried about the global fallout if or when that bubble burst.
So with all these fears, debt, central bank distortions, the potential China crash, how did they position themselves beyond just hedging stocks?
They went further. They prepared for, well, the really worst case scenario.
Deflation. Deflation, like prices actually falling across the board.
Yes. They pointed to historical examples. The U.S. in the 1930s, Japan's 2 lost decades, they saw it as a real risk stemming from all the debt and potential policy errors. So they held these complex derivative contracts linked to the Consumer Price Index, CPI.
Okay, break that down. CPI-linked derivatives, what are those for?
In simple terms, they were bets designed to pay off massively if deflation hit hard.
Yeah.
If the general price level started falling significantly, these contracts would become incredibly valuable.
So insurance against a 1930s-style economic collapse.
Pretty much. Insurance against the kind of outcome almost nobody else was seriously planning for.
And like the stock hedges, this wasn't free insurance either, right?
Not at all. Very expensive, actually.
Okay.
Those CPI derivatives cost them $129 million in losses in 2012 alone.
Ouch. On top of the stock hedge loss.
Mm-hmm. The total accumulated loss on those deflation hedges by that point was $335 million. But again, they willingly paid that price. They saw it as crucial protection against the unintended consequences of all the money printing and government actions.
Right.
Protecting permanent capital was the goal.
So let's try to wrap this up. It really is this fascinating paradox. You've got a company spending effectively over $1 billion in 1 year, hedging against global collapse and deflation, while at the same time pouring money into potentially volatile growth bets like Thomas Cook India or deep value recovery plays like BlackBerry.
It speaks volumes about their discipline, their long-term view, and, frankly, their corporate culture. The letter emphasizes things like integrity, reputation. They mention having an impeccable reputation of never renegotiating a deal.
That must count for a lot, especially in complex areas like runoff.
Absolutely. Trust is paramount. And they highlighted smooth management changes, too. Done the Fairfax way, fair, friendly, no egos. It points to a culture built for the long run.
And they seem to align employees with that long-term view, too, the share ownership plan.
Yeah, the ESOP. It had apparently generated a 15% compound annual return since it started, making employees genuinely wealthy co-owners.
Fulfills that old saying they quoted, no one washes a rented car.
Exactly. Deep alignment between management, employees, and long-term shareholders.
So the final takeaway for you, the listener, what should we really chew on from this 2012 letter?
I think it comes down to the cost and the value of patience and protection. Fairfax knowingly accepted significant short-term pain. That 4.5% investment return when they could have had 8.5%, that billion-dollar hit, they did it to maintain incredible liquidity. They held 31% of their assets in cash and short-term bonds, ready for anything.
They sacrificed what the market called a good year in 2012 because they were preparing for a potential disaster the market was ignoring. So if that grand disconnect they talked about eventually closes, maybe the economy surges or maybe the markets finally fall back to reality, then the true worth of that billion-dollar insurance premium becomes obvious in hindsight.
Right, and that leaves you with a question, doesn't it? What protection, what liquidity are you willing to pay for today, even if it makes your short-term results look worse? What's the non-financial value of being prepared for the storm everyone else hopes won't come? That's the thought to ponder from this deep dive.